Okay, so good morning, everyone. Welcome to the Macro Snapshot. We are Friday, September the 19th, 2025, recording this in the morning. Let's immediately just have a look. There was a bit of news from the BOJ meeting overnight. They didn't hike rates, although the vote was 7-2. So there were two dissenters who actually wanted to hike rates by 25 basis points. So the market interpreted this as meaning that the Bank of Japan is getting closer to normalization or to continue normalizing their policy, and there could be a hike maybe in October or even later in the year. In the press, so what we've got here, let's just look at the market reaction. So this is obviously very short term. This is a tick chart, so very short term, just of pricing for October in terms of overnight interest rate swaps. And we can see that just before the meeting, it was at about +9, so 9 basis points of hikes. And you can see here, this is the market reaction to that news of those two dissenters who pushed for a 25 basis point hike. I mean, it's not a huge sort of thing because we have like from 9 basis points up to 13 basis points, 4 basis points. But nonetheless, sort of symbolically, that is sort of, maybe signaling to the global markets that the Bank of Japan hasn't forgotten about the possibility of further normalization of rates. Having said that, in the press conference, Ueda was a little bit more circumspect and essentially saying that they expected both growth and inflation to sort of moderate over the short term, but then pick up in the medium term. So that's wage-driven inflation and economic growth. And so he wasn't exactly saying that the economy is slowing down and that inflation is sort of deflating or anything, but he wasn't also expressing any need for a rapid normalization of the interest rates. So the thing is, it's going to be an interesting one. The other thing which also got the market's attention from that meeting was that Japan, the Bank of Japan, has an enormous quantity, about $500 billion in dollar terms, about $500 billion worth of ETFs and J-REITs, so sort of real estate investment trust. Basically, they signaled that, and which have been holding, over the last 10, 20 years, back to about 2002 with the crisis there. But essentially, they announced that they were going to start selling those off back into the market. So that sounds like a recipe for market dislocation. But when you actually look at the numbers, they're considering. I've got the numbers here. They're looking at about $4 billion worth of ETFs and REITs every year. Now, as I just said, they hold it just over 500 billion. In terms of these assets. And with a straight face, Ueda in his press conference said that it may take about 100 years. Ueda has a sly sense of humor, and he said that this would be projected to take about 100 years. So the point is, can we react to that and say, oh, they're about to hike interest rates and they're selling off all their assets back into the market? I mean, it is symbolically a move, but let's not sort of over exaggerate and let's keep an eye on the data. Having said that, as I say, the market definitely has readjusted. We see all the bond yields, not just for the pricing, but we see the bond yields in the 2 year all the way up to the 10 year in Japan. Sort of rising a little bit, and that's important because remember that the Japanese bond market, as we all know, is outside the US, one of the biggest in the world, and therefore what Japan does is significant, and there could be some kind of contagion effect or sort of flow-on effect with slightly higher yields. And the other thing as well is that, of course, the higher the nominal yields in Japan, that means that Japanese investors, which for the last 2 decades, 2 or 3 decades, have essentially been looking for yields overseas, so outside of Japan, that may encourage some kind of repatriation of Japanese assets back into Japan because of the yields at home are getting slightly incrementally sort of more attractive. And of course, when those assets are repatriated to Japan, those assets need to be redenominated or the money needs to be reset into yen. So at the margin, this could be a positive for yen. Let's look at the yen reaction to all of this. If we just go into the chart here. So I think I put on a 3-minute chart. Yeah, so you can see that on the 3-minute chart here, you can see that as this news came out last night, about 11:30, you can see that the US dollar sold off against the Japanese yen. But, there you go. So if we just scroll forward a little bit, here we are this morning at 7:20, and you can see that that move actually only lasted about 20 or 30 minutes, and that the US dollar has pushed back up. Now, can this, if we put this on the daily chart, can this continue? I would have to say that there's the spike down for the US dollar, and it's now pushing up a little bit more. We'll see. I mean, but essentially at this point, if we just zoom out a little bit, we're still within a trading range. You know, can this US dollar strength continue? We'll have to have a look because yesterday we got data from the initial jobless claims and continuing claims, and the idea here was that the continuing claims were a little bit higher, and the initial jobless claims the continuing claims were a little bit lower, and that the initial jobless claims were significantly lower as well. Let's actually have a quick look at them. And the reason I want to say this, let's just bring this up. Give me a second here, I'll bring it up, is that that caused a bit of a sort of a hawkish repricing post the Fed. So let's just put this on to the 18th. Yeah, so you see the initial jobless claim. So you see that the prior was 263,000. Yesterday expecting 240, we actually got 230. This is actually a very, this is like 30,000 or 32,000 less than the prior. And so that whole sort of narrative which we had last month of, oh, maybe the employment situation's worsening and that, you know, the Fed needs to be cutting and, you know, all of that sort of, you know, sort of panic stuff. Basically, we have very, very healthy initial jobless claims yesterday. And also the continuing claims, you can see that they were lower than expectations, 1.92 million versus 1.95 million. And then actually the last month's was revised downwards. So all that to say that in data, employment data combined with the Philly Fed, which you can see here was 23 expected versus 1.7, so very strong, basically put the market in a bit of a risk on move, saying, hey, maybe the Fed doesn't need to be cutting so aggressively. Maybe the economy and the labor market is not as weak as outlined by Powell, and therefore that caused a bit of a sort of a bid in the dollar. The bonds sold off, especially the front end of the curve sold off quite a lot. Gold had a bit of a rough day. So that data is interesting. You see how sensitive the market is. But this morning we've got news that the continuing claims, there was actually sort of a technical error coming out of what was the state? I saw it this morning. Was it Wisconsin? Sorry, one of the US states. Basically, there was a technical error, which was they made a mistake by, I think, tens of thousands. And so that number may actually have to be revised next time downwards, sorry, upwards rather. So the point I'm trying to make here is that this data is not perfect. We know that under Trump and Doge, the Bureau of Labor Statistics lost a lot of people. A lot of people were fired. They have less resources. The data does seem to be a bit patchy. There are some kind of errors creeping in. The market's trading on it. But we now live in a situation where there are going to be sort of revisions. So my point is as well that this is going to be interesting today, that yesterday the dollar went up, the bonds sold off, gold, as I said, had a tough day. Will that be reversed today as you know, this sort of new information hits the market this morning that actually the continuing claims there was a technical error with this number and it may not be completely accurate. Anyway, something to look at. Excuse me. I'm just going to grab some tea here. Okay, so much for the Japanese yen. Let's continue and see what else is happening. We also had some news today about the situation with borrowing in the UK, and we know that the UK gilts have been fairly sensitive. There's a sense in the UK that fiscal discipline is completely lacking. There's a sense that the government really needs to get its house in order. And what's happening is that we've seen this is the daily chart here on the gilts, the 10-year gilt here, the 10-year bond. And basically what's been happening is that the UK and the pound sterling have been trading a little bit almost like emerging markets in the sense that fiscal discipline and high inflation, it's not causing and those higher yields is not causing the pound really to rally so much as any sniff of fiscal lack of discipline is actually causing the pound to sell off a little bit. And we can see here, so what provoked this, you can see here on this daily chart, you can see a fairly dramatic sort of a gap down on the 10-year bonds in the UK, and that's basically because the estimates of public sector net borrowing. So net borrowing for the public sector. Just keep in mind that previous was 2.8 billion pounds. 2.8 billion pounds. The estimate was for 12, just over 12 and three quarters billion pounds. But that was the estimate. But the actual number for the new estimate is 18 billion. So we've gone from 2.75 billion to 18 billion estimate for public spending. So all that to say that it looks as though the UK is really spending too much. It's deficit spending. It seems to be sort of, slowly, I don't want to say getting out of control, but lacking discipline. And that also means that the Chancellor of the Exchequer, Reeves, she's going to have less sort of fiscal space for stimulus and for growth policy. So all of that is not great for the UK. We also have the BOE yesterday, which kept on hold, so they didn't sort of cut their interest rates. They're still worried about pretty sticky inflation. So all in all, the UK is facing, relatively sticky inflation, a government which can't really stimulate or pursue sort of growth policies, and too much government spending. And it's interesting that that's just not a great sort of cocktail. And if we look at the pound, now the pound has been doing quite well, but you could argue that's also US dollar weakness. And you can see here the pound, failed to make a new high, kind of like a double top for the technicians. And you can see it's actually sort of pushing downwards here. If we just throw in a few moving averages, probably the moving averages are pretty flat, but you can see it's gone through the 20, now touching the 50. This is pretty key. If it gets through this 50, you've got to say that the next level down is probably down here at the 100, which also is a, kind of an interesting horizontal support level at 1.34. So the point is that the pound is starting to get under pressure. Combination of complexities at home and negativities in the home market. Also, the US dollar is having a little bit of a bounce. If we just look at the US dollar, the dollar index, as I said yesterday, the market unwound a little bit of this sort of negative positioning. And it's interesting here, just technically, there was definitely a rejection here of the bottom, sort of like a double bottom rejection, fairly sharp rejection here. Still just at the 20-day moving average. So there's no need to get too excited. It's not as though we're having some huge bounce here. This could just be a technical bounce. And the structural headwinds against the US dollar are still present. So I will be interested today just to watch sort of the close action, as I said, just to see whether the fact that yesterday's continuing claims and initial claims data is going to be revised, whether that will cause a little bit of weakness in the US dollar today. Let's keep an eye on that. But so far, the US dollar is bouncing. And again, it was very, very oversold. Positioning wise, everyone was short. So this also could have elements of a short squeeze. Let's just continue to monitor that. And possibly what's going to be influencing that today will also be, we have some Fed speak. So we have Miran speaking. Now, remember that Miran is Trump's puppet. He's newly appointed to the FOMC. He voted for a 50 basis point cut. And if you actually look at his dot plot on from Wednesday, he's actually arguing for, I think it's like 150, 125 or 150 basis points of cuts. So 1.25, 1.5% of cuts by this year. So dovish that he risks losing any credibility. But nonetheless, he apparently is giving a speech today. Let's listen to let's say, a sort of a White House slash Uber Dove view of things. Apart from that, we had Kashkari and Daly. Now, Kashkari's speech, I don't know where he was speaking from, but the headlines were just released about 10, 15 minutes ago. So let's just have a look here. Kashkari, I think it's down here, just on the Bloomberg. Yeah, so let's just have a quick look at these together. Political threat to Fed, a risk for inflation. Okay, fair enough. Fed strongly committed to 2% inflation target. So Kashkari is pushing back a little bit here. Raised estimate of neutral rate to 3.1. And that seems to be really what's happening here, is that although the Fed does have a 2% inflation target, I think there's, in a de facto way, no one's going to say this in public, but they seem to be acknowledging that, maybe the neutral rate is a little bit higher, that maybe, inflation at 2.5, 2.6, 2.7, 2.8 is going to, be reasonable. And at this point, they really should put the focus on keeping the employment situation kind of strong. And that's interesting that Kashkari has raised his estimate of the neutral rate to 3.1. Inflation may persist, but sharp jump unlikely. Again, justifications for putting the focus on the employment mandate. Okay, this is interesting because Kashkari had been relatively hawkish. Now he's suddenly saying 2 more rate cuts appropriate this year. So that's on the dovish side. So that is really, remember that the dot plot signaled a cut yesterday, on Wednesday, and also 2 more this year. So that's interesting that Kashkari is the first one post FOMC meeting to sort of come out and sort of confirm that they are, he is looking at 2 cuts. So the dollar probably won't like that. The front end of the yield curve will probably like that. So the 2-year, the SOFRs, those things will probably like that. Maybe gold get a bit of a bounce on some of this. We also have Mary Daly speaking a bit later today. Let's have a quick look there and see where Mary Daly's speaking. And the reason I want where are we, central bank? The reason I want to look at this stuff is just to see whether those dot plots signaling another two cuts, because the market is still pricing those in. If we actually go and see what's happening here in terms of pricing, we did get a little bit of for the December pricing here. You can see that it did spike up a little bit yesterday, but it's subsequently come down. You see yesterday it pushed up to about 42 basis points rather than 50. But we've come back down now, close to 44, 45 basis points. So the point I'm trying to say here is that for October meeting for the Fed, they've still got 23 out of 25 basis points priced in. So almost a full cut priced in here, 92%. And then if you look out to December, not quite at two more cuts at 1.75. So maybe the market's going to be happy with that at the moment. But, we're not deviating. The point is that we're not deviating too much from the dot plot, which is calling for another two cuts. So as I say, Kashkari's comments, the fact that the initial jobless claims, or actually the continuing claims data, may be a little worse than we thought, that could give a bit of a boost today for, as I say, to things like gold, other currencies versus the US dollar, which may weaken a little bit. And who knows, maybe the stock market will actually like that as well. The stock market is quite enjoying these potential two cuts from the Fed at the moment. Okay, yeah, so I just want to look at when the Fed speakers are. So Miran apparently is going to be on CNBC. Looks like that's 11 o'clock. He's also going to be on Fox. Looks like later on this afternoon. It doesn't have dailies here. Okay. That's interesting, but apparently Daly is going to be speaking. Okay, apart from that, guys, I also just want to have a look at, we have Canadian data this morning, which could be quite interesting. Let's look at that. We have economic releases. We have the retail sales. Now, the reason this could be important, as always, the excluding autos number, that was 1.9. But look at this. The market's expecting the headline to be negative 0.8 and then negative 0.6 for the retail sales excluding autos. Now, if that's confirmed, that would really it's just more information about the state of the Canadian economy, which does seem to be deteriorating. The labor market seems to be deteriorating. The overall economy seems to be weakening. And so we will keep an eye on this retail sales, because if you remember the BOC on Wednesday morning, Governor Macklem came out with a fairly downbeat sort of analysis of where the Canadian economy was. He said it was being quite heavily affected by the collateral effects of Trump's tariffs and whatnot. So the point is that if this retail sales weaken, that's not going to be good for the Canadian dollar. And again, maybe not so much against the US dollar, which has been quite weak, but against the other cross currencies. And if we just have a quick look here and just see how the market is pricing for Canada, you can see that we at the next meeting, the market's pricing in only about a 50% chance of a cut. So it's still a coin toss up for the next meeting in late October here. But if we get weak retail sales in Canada this morning, that pricing could go down to minus 16, minus 17, minus 18 basis points, and the percentage of chance of a cut could rise to into the 60s, 65, something like that. So that's definitely pretty interesting to keep an eye on for that. And just while we're looking at that, let's look at the Canadian dollar. And again, maybe not only against the US dollar, it has quite a high beta against the US dollar. So if the US dollar is showing strength, Canada is doing okay, and vice versa. If the US dollar is weaker, Canada tends to underperform on the crosses. But if we have a look here, you can see that pretty much in a trade range here, to be honest, between 137 and up to about 130, let's call it 139. So it's in like a 200 pip trade range here, the US dollar. And I expect if the Canadian retail sales this morning is weak, that could further, break through this 100-day moving average up to the 200, or it could just drift downwards a little bit. On the other hand, if that's a bit strong, as I say, probably more interesting in a certain sense is the Canadian dollar versus some of the cross pairs. Interesting here, the euro going down against the Canadian dollar. That's probably heavily influenced by the US. What other ones? Just trying to sort of inform ourselves here. Let's see, against the Aussie. Down against Canadian. Okay, so the Canadian dollar, but as I say, the Canadian dollar has a high beta to the US dollar. So some of this could also be a reflection of the US dollar strength, relative strength over the last few days. Finally, guys, today what we do have is the President Trump, President Xi of China a phone call. I think that's at 9 o'clock, so in about an hour and 20 or so. That's going to be interesting, possibly talking about TikTok. The idea is that TikTok, there could be like sort of the US version, companies like Oracle taking a big part of that. Interesting to see if there's any readout on the tariff situation, potential meeting of Thor in relations. Let's see what happens. Knowing Trump, there will be a lot of bluster, and it's going to be a fantastic meeting. And President Xi is his friend. Remember, they had a steak together in Santiago, in Chile, many years ago. So they're besties. One thing I just would also like to point out: we had a little bit of a push upwards yesterday in the VIX. And just looking at it, there was actually a lot of that was caused by more demand for the upside. So for calls, more demand for calls. And of course, with dealer positioning, they will then sort of hedge by buying the futures. So interesting here that the market is fairly bullish here. We see that on the stocks. You can see that even though the VIX ticked up a little bit, it's not really. There is some demand for downside protection. So long puts. But the point is, looking at the data from yesterday, the smile has kind of ticked up a little bit on the right side. So there's also a risk to right side, so the upside, and that's pushing up the VIX a little bit. So it's not necessarily bearish, is my point. That slightly elevated level in VIX, in the VIX, and you see here, the stocks pushing up, the Nasdaq, and also, of course, the Russell pushing up. Had a big outperformance day yesterday. So Russell pushing up very strongly yesterday. And as I've been saying over the last few videos, keep in mind that most or the vast majority of companies, the small cap companies in the Russell, their refinancing needs and borrowing needs in general is a function of the floating rate which is based on the SOFR, so the short term. So the fact that the Fed cut 25 basis points and in some shape or form will be cutting another, at least once or perhaps twice this year, and then going into 2026, all of that is good news for the refinancing needs and the borrowing needs of the smaller cap companies, especially. So I wonder if that's a little bit of the outperformance there of the Russell for the time being, enjoying a Fed which is cutting. We also have a White House which seems to want some kind of reflationary sort of policies. And actually, we have, relatively reflationary policies all around the world. We have expansionary policies. There's not a huge amount of desire for austerity. So governments around the world are pretty happy at the moment to be funding more infrastructure projects, defense projects. So there's a lot of money being spent. Inflation seems to have been, interest rates have been cut, more or less across the globe. The US is starting to cut now. So the point is that there is a little bit of a push for a reflationary environment around the world. So let's not assume that the stocks fall off a cliff anytime soon. And just in the context of a potential reflationary, normally commodities do quite well, your industrial metals do quite well, and emerging markets do quite well in this kind of situation, especially with a weaker US dollar. That's extremely positive in terms of the balance of trade for some of these emerging market countries, and also their debt situation. So if we look at where's my emerging markets? I've got it here somewhere. Here we go. So if you look at EEM, I mean, just look at this. Emerging markets have been doing pretty well in the last few months here. And that's a function of, the weaker US dollar. Weaker US dollar means that their repayments in US dollar denominated loans is less onerous. That gives them more fiscal space to boost the infrastructure. All of this is pretty good for the global economy. So, it's not only what's happening in the US, this is pretty good stuff for emerging markets and kind of second world markets as well, and also for commodities. And something I'm going to keep a lookout for is just copper, because in this kind of environment where, you have a reflationary environment, China actually is running some of the highest deficits they've had for a long, long time. So, we know the Chinese stock market's doing well, but let's not forget that the Chinese government, their level of deficits is actually historically at quite an elevated level. So they are pushing the economy. And you have to, we've all seen what's happened to gold. You see gold's had a big, strong run. We see silver as well. But the one I'm looking at is a copper. Now, we know that high-grade copper, the HG contract traded out of the US or out of New York. We know it had this horrendous dump because of Trump's capricious nature. and the fact that, that whole issue with the tariffs. But the point is, it is grinding higher now. And if I look at the London price here, which is maybe a simpler way of looking at things, which is this one, you can see here that the price of the London Metals Exchange, copper is grinding a little bit higher. And I just think that copper, if we do have a global economy which is sort of reflating, countries are sort of more on the stimulus sort of side of things. US dollar week, that's an interesting one to keep an eye out is for copper. But I have spoken for too long, so I'll leave it there. Have a great trading day, everyone, and have a great weekend, and we'll continue this next week. Thank you.